Aloha, YouTube investors. How is everybody doing today? My name is David Yansen. Welcome to my channel. Today is October 29th. It is Thursday, 2020, and we are looking at the earnings for my Robinhood portfolio. I have several companies that reported earnings yesterday and today. Two of those companies that we're going to look at in this video is Fastly and Sony. If you aren't familiar, Robinhood is my more risky growth portfolio, mainly for capital gains out of the three that I manage. Fidelity has an individual account for me. That account I actually moved from M1 Finance last month over to Fidelity, and I have videos showing you about Fidelity and my reasoning why I decided to move over there. And then I still have my Roth IRA sitting at M1 Finance. I still like M1 Finance as a brokerage. I just wish that they would have changed a couple things. So I'm keeping my Roth IRA there. So out of my Roth IRA, earnings today, I believe, was Equinix, the real estate investment trust, data centers. And out of my Robinhood portfolio is Amazon, Facebook, and Starbucks. But in this video, we are talking Sony and Fastly. From my Fidelity account, I think I have done all of my holdings with the exception of Costco, I think, for this month. And then next month, I will go into some of my other. But I do have videos already for JP Morgan, Bank of America, Tesla, IBM, AT&T, Verizon, all those out of my Fidelity account. So if you just go down to the playlist, and you can see all my brokerages are broken up by brokerage, by the name, and you can click on it, and you'll see the title for IBM and Intel, or whichever. So this video will have two holdings, and it's Amazon and Facebook I will probably just do individually just because they have a lot of information. So Sony right now, I own 3 shares. I got in super low in March or April. I think it was the end of April at $63.75. So I am up just a little bit over 30% with them. At one point, this was trading at, well, today it actually finished very well at 83, but for a couple weeks there, it was actually trading above $80 regularly through August. And then September, as you guys know, the stock market has reacted like it's been acting here in October. Very volatile, some really bad red days, and not so much high green days. So as far as Sony is concerned with their numbers, I was trying to get as much of this translated from Japanese yen over to US dollars. So I just kind of highlighted some of the numbers that I thought were that Yahoo Finance didn't translate. So as far as net income is concerned for this quarter, you can see here Sony's GAAP net income surged 144% year over year. So it was actually over $4 million dollars and $3.47 per share. As far as adjusted net income, 255.4 billion yen, which is higher than the previous year, and that number translates to be 2,400,000. So it's over 2,400,000. It's actually 2,400,047 and some change. So very good numbers in my opinion for Sony. I picked up Sony personally because of the PS5 that is coming out in November, so I specifically just for that reason, and probably in 2 or 3 years, depending on where I feel, where I feel that the company has topped out, I will probably just get rid of the holding. So their dividend is only paid quarterly, or not quarterly, is only paid annually. So, and I do like having some international exposure besides the 2 ETFs that I own, but they're not really, their stock isn't really one, in my opinion, that does enough growth for me to hold on very long term. Now maybe over in Japan it's amazing, maybe it's like like Samsung over in Korea. I'm not sure. I don't follow the Nikkei over there in Japan, their stock market exchange, to know how well it performs over there. But for me, it was just a pickup because of the PS5. Tons of new games are coming out. The holidays are coming up as well too. So people who don't upgrade to the PS5 are going to be buying more games for their kids or maybe for themselves. for their PlayStation consoles. And Sony does produce some games, so they're not just the console; they also produce some games as well too. So they'll pick up some revenue there too. So as far as their segment results are concerned, you can see here. This is their gaming networking services. Sales grew over 11.5% year over year, and a lot of that is because of the stay-at-home economy. So you don't have to get ready and go to work an hour ahead or 2 hours before. You work from home, or the kids are taking class online. That happened through the month of April, May, and then I think classes ended in June here in Hawaii. So you had a lot of people that were just went out buying PlayStations. I wasn't looking for a PlayStation, but I just happened to be in Target one day, and I was like, I just went by the aisle there, and all the PS4s were gone, and almost all the games were gone. So, and the same thing with GameStop. Somebody told me, the guy, I was like, oh man, I've never seen you guys with this such low inventory, and he was like, yeah, GameStop sold out too. So the stay-at-home economy really helped Sony on that side of it. What didn't help them is their pictures. Their pictures is their movies, their media networks, and advertising and stuff like that. So because productions were shut down, that they were not able to release any major pictures and TV shows and stuff like that. And it's just been this last month, I think the end of September, that Hawaii Five-0 and Magnum PI started filming again here in Hawaii. And when I drove by the set of Magnum PI the other day, they were all wearing a mask, and then they separated to do their lines. So I don't. I guess they're just going to edit people standing next to each other or something. I'm not sure. So if you go to Yahoo Finance, you can see the rest of the numbers here for Sony. Like I said, I really just, they're not a dividend play for me personally. I really just like them for the coming holidays and the new PlayStation system. And about every 5 years or so, they come out with a new system. So maybe in another 5 years, I'll pick them up again. The sales of their PlayStation console traditionally start to fizzle out at about year 2, year 3. So, and that's sometimes they'll come out with a pro edition or a slim edition 2 or 3 years later. So maybe the stock will see another rise at that point. But I'm probably only going to hold on to it until I feel like I've gotten, enough money from it, and then I'll get rid of it. So next is Fastly. Fastly, I have dollar cost average down a little bit. Now I am up to 1 share with them. This is a risky play, especially for me. My average cost is $77.93. The stock completely plummeted on news last week, or I think the end of the week before, that because of losing TikTok, the U.S., the president here is against TikTok. He believes that because TikTok ByteDance is owned by the Chinese government, that they will take the data that they collect here in the U.S. and will send it back to the Chinese government, and that could be a security threat. So that was Fastly's largest client. So when they lost them, their revenue went down. So Fastly came out ahead of their quarterly earnings report and said, hey, listen, our numbers might not be as good as possible because we did lose a big time client. So the stock just dropped. It dropped all the way from like 130 something bucks, I think, or 120 something bucks. We go 3 months out here. I owned them on October 13th, and the stock was trading at $131. And now it is trading at $67. So I am holding on to them because I like what Fastly does, and there's a lot of they already have some clients. I believe I read that Yelp is one of their clients, Pinterest is one of their clients. On their website, it had a bunch of their clients listed there, and I talked about that in a previous video when I first picked up the share. Now my strategy with Fastly is to just let the stock go where it goes, and then I'll add a little bit more. And when I say a little bit more, it's probably only 10, 15, 20 bucks because I don't have a lot of money, and it's not the best time right now as far as income coming in for me. So I'm trying to really just dollar cost average into my more solid Fortune 500 companies. So my Roth IRA, I automatically deposit money into that every single week, and Robinhood and my Fidelity account are second tier. So it goes Roth IRA first to make sure I get to that $6,000 max, and then my Fidelity, and then Robinhood. So unless something drastically happens in a company that I feel is really solid. So when Pfizer really started to drop, I picked up more shares of them. If Starbucks all of a sudden drops down to what, $74 per share, I think is what I'm at, then I will pick more up of Starbucks. But Fastly, maybe not, because they're not profitable and they are pretty risky, and the numbers show that right here. Non-GAAP EPS misses by 3 cents, and these are all negative numbers. This isn't 3 cents off of they were supposed to make a positive 25 cents. This is 3 cents off of they thought they would miss 22 cents negative. So their revenue is good. That is what I do like about them. And it says right here on Seeking Alpha that year over year up 42.6%, but they still missed by 0.35 million. So, but bringing in revenue of 71 million is still good for a company that isn't profitable and really isn't doing much. And as you can see here as well, according to Seeking Alpha, their customer count has increased from 1951 to 2047 for the quarter of 2020. And then one other thing here on Seeking Alpha that I wanted to show you, and it basically explains revised guidance on TikTok woes to continue. Oh, and I did forget to mention with Sony, Sony did improve their guidance for the rest of the year as well too. So if Sony stays in the 80s, I wouldn't pick up on them personally myself. But if you just wanted to grab them and hoping that they jump into the $100 mark, then that might work for you. But for me personally, that wouldn't work just because I already bought into them so low. So with Fastly, my strategy is with their earnings. Their guidance for quarter four, they're saying consensus anywhere between 80 and 84 million, and that would be a loss per share of either 8 cents or 12 cents. The consensus is 2 cents loss. So we'll see what their revenue brings in for the fiscal year of 2020. The consensus is looking anywhere between 290 to 291 million, where Fastly is saying we'll probably get in between 288 million and 292 million. So this is a risky company. If you decide to go in on them, make sure that, in my opinion, that you are good with your solid investments before you go into a company like Fastly. But I really just picked them up because they are live stream data. That is kind of the future. Amazon is now starting to move that direction. So, and I'm not sure I haven't looked it up to verify how far along Google, Microsoft, and some of the other leading companies are with that. So I hope everybody has a great day. I do ask that you help me get to 1,000 subscribers. I'm a little over 500 right now. Otherwise, mahalo and aloha.